that's a good question, and I come across that very often when I speak to my clients who question or argue the benefit of use of data mining and sort of in-depth data analysis. But I truly believe that being able to support the equity story based on which the company is being sold with the actual proof points or actual tangible evidence helps a lot in positioning of the business, and that in turn it helps with the valuation and achieving a value maximization in an M&A process. And the way it works practically is that the data that's being sort of gathered by the company's internal processes or management systems and stored in a data cube is then analyzed to see whether there are any micro trends that could help explain how the business performs and find areas where the business can improve, be it on the sales level or profitability level, to drive valuation. And a good example could be a retail chain that monitors the weather conditions around its stores and then adjusts the pricing of different items depending on the weather forecast. So, for example, in the summer, in the very hot days, the price of ice cream or chilled soft drinks might be temporarily increased to take the benefit of those circumstances. And the way it works is that the business would have electronic price tags that can be changed easily. And then once the data is collected, it can be shown that a proactive management of pricing helps increase profitability of different outlets in the network, alongside changing weather. Other example could be, let's say, a pharma company or that sells different products across different geographies. And one items of the equity story could be that a particular product is expected to be particularly successful in a geography, and by looking at the recent monthly or quarterly data, per type of customer, per geography, per product, you could dig into those positive trends that then you can present in your marketing materials to again support the equity story and thus business valuation. It sort of boils down to how people or human beings can deal with an overflow of data. And then the question is whether there is a stage beyond which more data actually makes decision-making process more difficult and causes people to lose the overall concept, overall rationale of doing the deal, and instead focuses them more on very minor items that lead to sort of analysis paralysis, as I call it. I think in M&A context, being able to not to lose the bigger picture and focus on the key elements, key parameters that help assess the viability of an M&A transaction is critical, and data analysis, due diligence should help in that process, but not overshadow it. And I've come across situations where the overeager deal makers would spend too much time and focus too much on analyzing due diligence a company, but forgetting that it's a competitive process and some other potential buyers might take a different view, make decisions quicker, move quicker, and basically buy the company faster. So everyone needs to be successful in M&A needs to find the right balance between doing the right amount of due diligence that's really needed to assess risk and value, and also a situation where going too much into detail will have quite opposing effects and would prevent buyers from doing a deal. the data that's being included in the VDR and the disclosure process that any seller needs to do with regard to the company they're selling, that's very important. And I don't think there is too much risk of showing too much. I think from the seller's point of view, the bigger the disclosure, the more protected they are from the post-closing risk perspective. I think it's more in terms of guiding the buyers what they should really look for, and from the buyer's perspective, it's prioritizing the elements that are needed, both for their own bosses, the decision makers on their side, be it investment committees or boards, but also on the financing side, and making sure that the analysis that's being done is something that the financing banks or other sources of capital actually require. And it's making sure upfront and setting up a plan of what's needed, where the focus should be, and then focusing on it. And I think an important role here is for the advisors to play, both the bankers and also accountants or consultants or lawyers, is to make sure that the scope of work that needs to be performed during the M&A process is clearly defined, is pre-agreed with the client, and covers all the items that different decision makers might need, and that there are regular catch-ups with to discuss findings from that due diligence process, just to make sure that it doesn't go astray, and that the due diligence teams really focus on important items. The more often those catch-up happen, and the more communication between the client and the advisors, the better the process is managed, and the lower risk then of analyzing the data that it's not critical to get financing or to sign a deal. For a business to include a potential synergy effect in the equity story is very important from the value maximization point of view. An ability to build a story around the strategic fit between the target and the buyer, and the potential synergies and the value that you might assign to them is very important, because it gives arguments for the buyer to pay the price that the seller wants, and whether it's there is an issue with talking about it and highlighting it to the buyer too early. I don't think so. I think the earlier you do it, the quicker you get the buy-in from the buyer that this deal makes sense, not only financially but also from the strategic point of view, create synergies, and you also and thus you help the deal team on the buyer side to present it in the right way to their board and get the approval to continue with the deal from their CFO or CEO or the board. And the way it works from the seller perspective is that you hook them in, you create this strategic rationale around the deal, which means that the buyer will be then more inclined to pay a higher price, because they see that that particular acquisition adds a lot of value. And as we know, the decision-making process within a large organization, large corporate, usually takes time. So to be able to present the strategic rationale earlier, it actually help the buyer with their own internal processes, and set them up better prepared and better educated for the rest of the due diligence process. So I believe there's not the early communication on synergies is critically important, and actually works to the benefit of both the seller and the buyer. The technology has started to replace people, and it started with data rooms. I remember physical data rooms 15 or 20 years ago, where all the documents were printed in folders, and there were heaps of people coming into a physical data room to go through the documents. Right now, it's all it's all digitalized and digitized, and there's a much easier access. People can get access to information in a much quicker way, and they can also search for different words and run different queries based on the documents in the virtual data room. That really makes the life of the due diligence teams much easier and enables them to complete their due diligence in a faster manner. We also start seeing the use of as I mentioned before, AI or data analysis, where the large sort of chains of data would be analyzed to find certain trends. And I would say that it doesn't necessarily replicate people, because people wouldn't be able to do that within the time frame of an M&A deal anyway. It just creates a different opportunities and different areas of due diligence, which now can be actually looked into or used. So I think the use of technology broadens as well the due diligence scope, and helps people make more educated decisions. But when you look sort of really long term into the future, I think that a lot of more sort of bread and butter due diligence, review of legal documentation, review of financial statements will be more and more done by technology, by AI, and the role of consultants, accountants, and investment banking advisors will be then to draw the right conclusions from that data analysis and then present it in a concise way to their clients. So the value add that's really something that the clients will be paying for, rather than just pure data analysis, which will be automated. I think in terms of the role of advisors in an M&A process, I think first of all they used more often these days, and they cover more topics. So instead of you having your three main due diligence streams, financial, legal, commercial, you start having plenty of additional areas that you really need to look into: ESG, pensions, tax, operational efficiencies. There are a lot of additional areas that buyers focus on now, and it's also because due diligence can be done quicker now thanks to technology, so people can expand the due diligence scope. But what the clients really want from their advisors is this analysis and the conclusions based on what's in the data, what's in the contract, and an ability to deliver that fairly quickly and prioritize. So again, going back to one of the questions before, prioritization here, and making sure that the advisors really separate and highlight the key points to their clients is something that the clients expect and are willing to pay for. And when it comes to corporate development, well, I think especially when it's corporate development in relation to M&A, I think databases in general that collect information about the companies around the world and more information about them, they help facilitate the search process for the right M&A targets for a corporate, also for financial sponsors, and that helps with the initial filtering. So you can very quickly run a few queries in those databases that would then come up with 10, maybe 20 potential targets, which you can then review in more detail with your advisors or in investment bankers. So I think the technology helps remove that time-consuming first layer of initial pre-screening filtering, and then again helps people focus on the right targets, which again is important given the limited time people have and also sort of abundance of opportunities to invest. Yeah, so when it comes to the use of different platforms in an M&A context, I would group them into two buckets. One is I call it data exchange communication tools. By those I broadly mean the virtual data rooms, which could be used as a platform to exchange information and store documentation and data before the M&A process goes actually live, so during the preparatory phase. And then they have a second life once the deal goes live. They basically provide the platform where the buyers can find information and data about the company and help the seller manage access to this information, manage security of this information, and also monitor the activity of the buyers. Which documents they focus on, what type of documents they open the most, what sort of questions they ask, where is that they really focus. And to do that, obviously, you should have one provider, one platform that will stay from the very beginning until the very end on this one particular deal. And that should be, the best is a third-party provider with the right security setup, and also a brand name that's credible for the buyers and the sellers. Then there is another aspect, which is the actual analytical tools that are used to analyze data. And here, I think it's all about the USPs, the in-house algorithms and IP. So I think here it's really up to each advisor to use it, on their own, run their algorithms and their tech tools, and come up with conclusions and findings. So that these are highly sort of sensitive tools that are very rarely shared with anybody else, because they sort of really intrinsic IP of each advisor, and they usually used separately. And what the client sees or the buyers see is pretty much the outcome of the analysis. 2 years ago, we were sort of in between pandemic lockdowns. So I remember H2 2020 as a beginning of a very, very busy period that lasted for 18 months. And I think it was the busiest period in M&A globally ever. So it was easy to sell a company. It was easy to get to the valuation the sellers wanted. It was easy to negotiate hard with the buyers, and it was pretty much a seller's market, where from the sell side perspective, negotiation was easier, and obviously from the buy side perspective, what mattered was speed and ability to be faster than others, to be the successful buyer of the company. So that was a sort of dream environment for the sellers. These days, I think we have moved to the buyer's market. The buyers have become much more, I would say, focused on selected sectors. They become selective when it comes to sectors, type of companies, geographies, business models, and so on and so forth. And they also, at least some of them, they sort of push the risk off button, which means that they're not ready to part with money as quickly as they used to. And last but not least, the financing markets are not as liquid as they were. Both debt and equity markets are in some sort of dislocation that makes financing more difficult and deals more difficult. So what you see now is that the sellers talk to the much smaller number of buyers. Very often these are bilateral discussions, which also means that the processes and the negotiation phases tend to be longer. There's more back and forth, and the sellers need to be more creative especially when it comes to valuation, to agree a deal where where there is a structure around it that would get the seller to the valuation they needed. It also means that sometimes sellers need to concede on several topics, including valuation, just to make sure that that the deal takes place. And what we've also seen, and the volumes globally in M&A also show, is a certain slowdown, especially in deal count, and that's predominantly because of the market environment and people who don't have to sell postponing the sell side processes for later, 23, 24, just postponing time because they know that if they try to sell today, they won't get to the valuation they want. Yeah, and lastly, I think what is a great opportunity for buyers is that they can make unsolicited offers. They can come in unexpected, place an offer, put an offer on the table, and if it's competitive, they can actually force the seller to sell and preempt any competition, any process that would put them in more difficult position. And if those buyers have the financing ability and can move quickly, their unsolicited offers might actually be accepted by the seller, and those processes or those discussions can very quickly come to fruition and a deal signing.